You're listening to A Book with Legs, a podcast presented by Smead Capital Management. At Smead Capital Management, we advise investors who fear stock market failure. You can learn more at smeadcap.com or by calling your financial advisor.
Welcome to A Book with Legs podcast. I'm Cole Smead. I'm the president and a portfolio manager here at Smead Capital Management. At our firm, we are readers and book junkies. It can be said that leaders are readers, and we believe books provide us a great source of information for filtering what is and isn't important for us as investors. Investing is the last great liberal art, as we'll learn and talk about today, and the best way to spend a lifetime of learning. This podcast is for readers, thinkers, business-minded people, and investors who want to grow their knowledge from great authors and their writing. Charlie Munger often talks about using multiple mental models and analysis. Our aim is for this podcast is to help listeners test Munger's theory in business, markets, and people. We're glad you've joined us for this episode. We're going to talk about a book that speaks to the thesis of this podcast and our personal views of what it means to learn. Hosting this episode along me is our chairman and chief investment officer. I like to call him Dad, Bill Smead. Thanks for joining me, Dad.
Great to be with you, as always.
Robert Hagstrom is joining us to talk about his book, Investing, The Last Great Liberal Art, that he published in 2000. Robert has published other books, including his most recent work, Warren Buffett, Inside the Ultimate Money Mind. Mr. Hagstrom is the chief investment officer and senior portfolio manager at Equity Compass. Prior to joining Equity Compass, he was a portfolio manager at Legg Mason Capital Management, running the Legg Mason Growth Trust. Before we get going with Robert, Bill, is there anything that you're kind of, looking forward in our discussion?
Cole, in my career, Robert has been a thought leader and explainer of how to have investment success and how to accumulate wisdom.
I agree, and I'm stoked to get started. So let's jam. Robert, as you've probably heard, your writing has influenced us hugely as individuals, investors, and teachers to other people. Thank you for joining us today, and we appreciate the chance to talk about your work.
Well, Cole and Bill, it's great to be with you. Thanks for the invitation.
So, Robert, tell us what prompted you to write in Investing, The Last Liberal Art. Also, can you explain to our listeners some of the background, how it ended up with this name?
Yeah. Well, you kind of go back to, I guess it was in those days, it would have been the Outstanding Investor Digest, the old Henry Emerson piece of research. And he had an interview, or I guess he had covered an interview with Charlie Munger, vice chairman of Berkshire, about a lecture that he had given at USC at the Marshall School of Business. I think it was Dr. Babcock's class, and it was an investment seminar. And so Charlie was asked to come, and he showed up, and clearly he said, the students were expecting me to talk about the stock market or stocks. And, I threw him a curveball. I said, I'm not going to talk about any of that. I'm going to talk about the art of achieving worldly wisdom, which I'm sure had I been sitting in the audience there, my eyes would have gone counterclockwise. I don't know. It's kind of like, where do we go from here? And then what Charlie did brilliantly was to outline the methods one would use to achieve worldly wisdom. And his thesis being that if you did achieve this worldly wisdom, it would ultimately make you a better investor. And so you kind of put the pieces together and say, okay. And Charlie's thesis was basically, you need to connect all the major models and all the major disciplines, somewhat like a liberal arts outline. So, physics and biology and mathematics, the hard sciences, but you go into the soft sciences of philosophy, sociology, and psychology, literature, all down the road. And he said, it's not necessary to become expert in each one of the disciplines, but just to understand the major mental models of each of those disciplines. And then what happens is that you're able to see the market more thoughtfully because you're looking through the lens of not just finance and accounting, but all the other disciplines to gain insights about what's going on or what might be going on. And I said, well, okay, I had written the Warren Buffett Way and the Warren Buffett Portfolio. And about that same time, I had known Bill Miller since I was a broker at Legg Mason, and Bill invited me out to the Santa Fe Institute in 1996 And we had gone to the what is called the Stanislaw Ulam Memorial Lectures that are held in the fall, and I went my first trip out with him in 1996 and attended the lectures, and it was really mind blowing because we were talking about ant colonies and Navajo Indian reservations and all this thing, and I said to Bill afterwards in a very dim-witted way, what does this have to do with buying IBM or selling General Motors? And he said, nothing. But what it does is help you to think differently. And so that began a relationship with Bill, and I continued to go to the Santa Fe Institute over the years and began to draw on the lessons of biology and complex adaptive systems and all of that. And then really began to expand my reading list into the other disciplines. Bill being, did his PhD in philosophy at Johns Hopkins, absent the dissertation, and helped me in that area. So really broadened out my thinking. And then to your last question, what prompted the title? When we titled the book, and the book came out in spring of 2000, and I called it Latticework after Charlie Munger's Latticework and Mental Models. I think it was called Latticework, The New Investing. And the book was a dud. It just didn't do anything. The two lessons are never bring out an investment book in a bear market. we were in the middle of the technology bear market. And the second thing is let the publisher suggest the title. Don't be so stubborn about your title. And Miles Thompson, who then had moved over to Columbia Business School, basically said, why don't we call it Investing the Last Liberal Art? And I said, okay, I was a liberal arts major, and maybe that'll work. Whatever you want to do. So he actually had so many of the hardback copies of Latticework that he went back to the manufacturer. They ripped off the hard copy front and back and slapped on a paperback cover that said Investing the Last Liberal Art. And those that have that paperback first edition will see, if they open it up, the pages of the book say Latticework on the top. It was actually the same pages they used in the hardback of Latticework of investing. But no doubt what happened then is that there were so many liberal arts majors in the investing world that resonated with them, and the book ended up taking off. And then we did the second edition, I guess, in 2012.
A real interesting thought. One of my first talks that I heard from Munger was he was talking to the Stanford Business School students, and he told them that psychology was the most undervalued of the subject matters. And then secondly, I shared a subscription for many years to Outstanding Investor Digest.
Yeah. There's not too many millennials that know what that is, Robert. So I appreciate the fact that I do. So let's you started the preface to your book out with this, conversation around worldly wisdom, a term that Munger, like you pointed out, uses. Teach our listeners what this term means.
Well, the concept of latticework, think about a fence. That was the imagery that we use. Some people have wooden fences on their backyard, and along the top are kind of, the lattice work or lattice of a fence that it kind of goes into, sideways and ups and downs. And it looks, to me, it always looked imagery as, connections between things. And so we kind of use the imagery of building a lattice work fence of models. And the idea was, if you thought about it from a physics-based world, you would think about it this way. If you thought about it a biological way, you would think it that way. But let's bring in philosophy. How does that work? And so the whole imagery was, connecting the dots, if you will, or the light bulbs, better yet. The light bulbs were on the fence, and they would glow on and off to what degree a certain insight would give you, better thoughts about what's going on in the market. And so that's kind of how we set it up in our mind. And so then the book naturally just went through the major disciplines. And I started with physics because, being a liberal arts major, that was my hardest subject in school. And so we went through the Newtonian world, the mechanistic world, which ultimately found its way into economics in the 19th century with Alfred Marshall, supply demand, and really still rules the roost today is more of an equilibrium model, a mechanistic type model of how to think about the economy. And then summed up that, that's incomplete. And it was the work at Santa Fe Institute with Brian Arthur, who had been doing a lot of work on complex adaptive systems and had worked with Bell to think about it from a biological aspect. And when you think about it from a biological aspect of a living organism that learns, evolves, adapts, changes, you quickly recognize that the biological metaphor is a much more appropriate way in which to think about markets than the Newtonian model. But of course, then at the end of the day, you're still looking for the Newton of the grass blades, because there's not a mathematical way yet in order that's capable of being able to predict these living systems. I actually had an email from Bill the other day. I said, do you think we'll ever get there? And he said, absolutely not. there's absolutely no way that we're going to be able to build a model that will be able to predict, these complex adaptive systems. The best that we can hope is to get to some probabilistic exercise similar to, celestial mechanics or something like that, where you can make odds-on bets. But the predictive ability in biological systems is beyond our grasp. And so you read, as Alfred Marshall then said on the sixth edition of his book that came out early 1900s, clearly the biological analogies are most apropos, but we don't have any models to work with. So we got to revert back to the mechanistic models that we've been using in supply, demand, and equilibrium. And because that's the only thing that we have to work with. So I always thought that was a sad state of affairs, because we're working with what we know is a faulty model that will give us faulty outcomes from time to time. But because we have no other map or pathway, we just have to continue to use them.
So plagiarism is totally legal in our business. And like you said, you've plagiarized great ideas from Bill Miller. I've plagiarized ideas of yours, Robert, from your book. Isn't Munger just plagiarizing when he uses the word worldly wisdom to kind of get into some of the educational part of what you get in your book? Luke 2:52 comes to mind, where Luke writes, "And Jesus increased in wisdom and in stature and in favor with God and man." Wisdom with God is biblical wisdom. Wisdom with man is worldly wisdom. Isn't that what Charlie's just kind of getting at, and from a biblical definition?
Yeah, that's very interesting. I've never heard that before. I appreciate that, Cole. Thank you. Yeah, I think so. But, he did say that, Charlie, just as I overdosed on Warren Buffett, Charlie overdosed on Benjamin Franklin. And if you go through the autobiography of Benjamin Franklin, there was the, probably the first example of worldly wisdom. And he always, Charlie kind of almost imitated Ben Franklin, to this day, and absorbed everything about Ben Franklin. And I think it was at the end of the book, we go back to the University of Pennsylvania, which was founded by by Benjamin Franklin. And you kind of go through those lessons of Ben Franklin. And he probably would be the very first, he was the very first modern liberal arts major, and the very first person to argue that we needed to think in these multidiscipline terms. I think the dean of the college there called it the habits of mind, that Ben Franklin adapted in his thinking, these habits of mind to look for answers wherever you can, in whatever discipline, as opposed to being singularly just a specialist in one area. Franklin was, I guess, in many ways, Charlie Munger's role model of how to do that.
Charlie often quotes books he's reading. Is the key reading alone, or is there more? After all, like Buffett says, if reading was all that mattered, the librarians would be millionaires.
Well, that's interesting. Yeah. I talked to Bill about that a lot. We talk about, Bill talk about a guy that reads. It's not only the volume, the stacks of books on his desk that he reads, it's the diversity of the reading. It just astounds me. He reads science, obviously, and he's, well-versed in everything, psychology, behavioral finance, philosophy, but he also reads classic literature, and he'll go back and read some of the classics, Moby Dick and things like that. I said, what are you doing? And he goes, you just be surprised. You pick up a little bit of here, a little bit of there, a little insight there about how to think about problem solving. And he's so diverse in his reading. I think clearly, if you had a book club and you could sit around and talk about books afterwards, maybe that certainly would be beneficial. But Bill is a solitary reader, and I don't, other than sharing a couple of snippets on a book, we've never had deep, long conversations about books. To give you an anecdote, there's that Bill is very close friends with Cormac McCarthy, very famous writer, and wrote the great trilogies and on the Western trilogies, and he actually was, has been, a great member at the Santa Fe Institute. Now, that's Bill and Cormac McCarthy could spend hours talking about a book, but Cormac McCarthy is one of the great American writers, and probably could keep Bill interested in talking about books more so than I can.
Well, by the way, this is kind of a book club, so this is one of our attempts, just so you know. Right, Robert?
Yeah.
The readers of your book learn that broadness is important. That's basically what you're referring to.
Yeah.
Cole and I both graduated from the same liberal arts school, Whitman College.
Uh-huh.
How do you view broadness in undergraduate education, and how's that going in the world of undergraduate programs?
Yeah, it's a struggle. And I actually, my alma mater is Villanova. I did my BA and MA in liberal arts at Villanova, my master in political science, because that's really one of the great liberal arts disciplines, because politics and political science has to take in so many other things, history and biology, history and psychology, sociology, on down the line. But I each year I work with interns at Villanova as a way to give back and help them, beef up their resume. And so the political science majors, I keep telling them, guys, you're on the right path. There's no cliche about a liberal arts education. So many people call it, an education for the Middle Ages, because it's not until you're middle-aged that you actually begin to understand how valuable it is. And the challenge is, you feel for the students, because mom and dad they're taking out loans, or mom and dad are spending a small fortune, and they're looking for a payback on their investment. And the way to get a payback on an education investment is to specialize. And to the degree that you specialize, you're more likely to get a job getting out the gates. And if you're broadly diversified, nobody knows what to do with you until later in life. Now, having said that, the CFA was a couple of years ago, and I'll remember it here in a second, did a survey of what executives of asset management companies were looking for in their executive ranks, for management. What were they looking for? And number one on the list was creativity. They just wanted people that could innovate and think different. Number two was think in multidiscipline terms. And I said to the author of the study, I said, if that is so important, why are we not spending more time in the CFA curriculum helping people understand and appreciate a liberal arts education? And he kind of fumbled with the answer. But clearly, those that study liberal arts and stick with it, even if you start as a finance major, but you broaden your view of the world afterwards, as Charlie Munger would say, you're going to be so much better off competitively, not only in your investments decisions, but in your ability to run organizations, the ability to attract talent, the ability to solve problems at the meta level of your organization will be so much better for you. But we do a lousy job of promoting it. I mean, I'll tell you, both Cole and Bill, everybody tells everybody how important liberal arts is, and everybody doesn't spend enough time thinking about how we can promote it in a much better way. It's disappointing.
I don't disagree. And you talk in this book, Robert, about classical education and the value to that. Just to give some historical context, I assumed you could do this, but I will find out real quick. Can you provide some, historical context to when a classical education began and when it kind of roughly ended? Because, I went to a liberal arts college and we did not do a classical education.
Yeah. That's a good question, Cole. It's a complex question. Yeah. Well, clearly it began, in the 1790s at University of Pennsylvania when Ben Franklin, because prior to that, education in the United States in the beginning of our country was, mostly divinity schools. Harvard, Yale, Princeton, William and Mary were divinity schools. These were schools basically that were preparing people to enter the church and theology. It was Franklin, was the one that said we need to broaden it out and go from there. But I guess it's a good question. The Great Books program by Hutchinson was very popular in the University of Chicago at the early 1900s. But I guess maybe post-World War II, I'm just going to take a stab at that, became a level of specialization where you began to see people deciding to be really good in this area and master this area. Now, in medicine, believe me, I don't need my brain surgeon to be multidisciplined. Just
Yeah,
figure,
no question.
just gotta just or my heart transplant. Just all I want you to do is study medicine, and maybe that's true, and there's certain areas that if you're a mechanic on an airplane, I want you to understand that pretty well, but in other areas of management, running corporations, investing on down the road, and you can broaden it out to being a psychologist, sociologist. It's just this incessant need in my mind that we have to be more broader in our thoughts. I think it has not really flourished in any great magnitude, except those little pearls of colleges that you mentioned, and some of the smaller liberal arts schools, Brown University, and others that you can think of. I've always, and I talk about it in the book, I was always fascinated with the Great Books program at St. John's College, and they spend 4 years doing nothing but reading the great books. That's all that they do. They don't have classes and any that you would think about in a university. They basically freshman year they're going to study the Greeks, Homer, the Odyssey, things of that nature, Plato, Aristotle. You go through it, and they're doing the classics in the freshman year. In the sophomore year, they're moving into a little bit more mathematics, Copernicus, things of that nature, Ptolemy. By the junior year, they're into the great books, Don Quixote, Meditations, Descartes, and they get into Newton here, and Rousseau and Adam Smith, and then in their senior year, they're studying, the Supreme Court opinions, Hamilton J. Madison. They go through Darwin's Origin of Species, and they're doing music. They're doing the great books, Dostoevsky brothers and Karamazov, Tolstoy. I'm just kind of going through my mind. Melville,
Sure.
Twain. I know they did Adventures of Huckleberry Finn, and so you leave after 4 years, and it just amazes me, how much knowledge they had acquired doing nothing but reading books. Now, to your point, Cole, this is a great book club, because what they do is their professors are not called professors; they're called tutors, and they sit there and discuss those books that they've read in group settings. And I've always said, if I had an opportunity to redo my education, I would have spent the first 4 years at St. John's College and then gone on to get a master's in something down the road.
Well, what I appreciated about all the books you listed, and I'll quote a little Thucydides here. He says, "My work is not a piece of writing designed to meet the taste of an immediate public, but was done to last forever." And that's what all those works have in common, is they've stood the test of time. So in thinking about this writing and these ideas, we look at and this is kind of one more question on the broader higher education question today. Humanities are dying on campuses, mm-hmm. and computer science degrees are proliferating, which is in so many respects, Robert, the opposite of what you just pled for, which was not specializing but being broad. What does this say? What does this say about the student today? In other words, from an equipment standpoint, but then secondly, meeting the needs of the problems we need to solve tomorrow.
Well, as I said earlier, I think this is a deficit. We've got a problem, and I understand the whole idea of specialization to get a job and to get a paycheck. I get it, but clearly that in itself is not going to advance anyone in a significant way than a liberal arts. So then the question is, well, what do you do? And I guess, what you're doing, Cole and Bill, with your program and others is that, when you're 25 years old and you think you're done with your education, no, you're just starting, and, you got to pick up books, and, investing the last liberal art is kind of a little Reader's Digest kind of preamble to how to think about it. But we list, hundreds of books in there and the St. John's College reading list. I mean, you got to start reading, and you've got to start diversifying your reading, and you have to educate yourself. You become self-educated in a lot of ways. If you're lucky enough to connect with organizations such as yourself, that will even broaden you further. But you've got to take it upon yourself to do it. If you don't, I just don't know how the future is so rosy and bright for you. It could be rosy and bright for your first 10 years, 15 years. But after that, where do you go from there? That's the problem. Yeah.
My college roommate's a perfect picture of what you would say. which is he had a 4-year degree in liberal arts, and then he went to the London School of Economics. He went into Anderson Consulting and then learned to code after he got there and had a hugely successful career. Kind of the opposite of the way people do it now. Let's switch gears a little bit. You write about Alfred Marshall's theory of economics as biological science rather than mechanical science. Explain this from your writing.
Well, you have to really go back to, you've got to go back to the beginning and Newton and when you kind of go through Principia and you can't overestimate how powerful Newton was at that time, because if you think about it, prior to Newton, if you wanted to ask questions about the world, the universe, you go to the church, and the church basically, and the priests and theologians would basically tell you this is how the world works, right? And then Newton comes along and he kind of develops these universal laws, and you just can't overstate how significant it was, because it meant that the scientists no longer had to rely on the divinity for understanding. They could begin to study it themselves. And so Newton, opened up this entire world of knowledge. And what happened, though, was that, and if you kind of think about the second law of motion, for every action, there's an equal and opposite reaction. Everybody started to latch on Newtonian physics to help explain their disciplines. And you can go back in the history and kind of look at this. But economics clearly said, okay, supply, demand, equilibrium, the second law of motion. So you had this entire Newtonian view of the world that was embedded in economics. And the mechanistic approach that Newtonian physics portrays is that it's predictable as a clock. You talked about the clockwork universe. And that's good. That's enviable, because, it kind of seduces you with a sense of certainty and gives you, the comfort that you have the absolute answer. And then, obviously that goes on for a couple hundred years. And then Alfred Marshall, and if you go through his textbooks, it's all equilibrium based, but, he's struggling with it too, because, his models are explaining a system, an economic system that doesn't seem to behave like a clockwork universe. It's a reductionist philosophy where if you understand the individual parts, you can understand the whole. That works in physics. That works in atoms and planets and things, inanimate type objects. But when you get into organic systems, it's the whole that's influencing the individual parts, because the individual parts are learning from the whole. They're evolving, they're adapting, they're changing. And so it becomes you can't study biology from a reductionist standpoint. You have to study the system as a whole. And as I said earlier, there's just no mathematics yet to try to predict this constant evolutionary process that's going on in biological systems, which are economies and stock markets. They're exactly biological systems. There's no math to do it. And so you're kind of left with that, okay, what do I do next? And, Santa Fe is working hard at trying to understand nonlinear dynamics, and they're doing their best. But as Bill says, he just thinks it may be next to impossible that we'll ever reach a level of certainty that Newton had reached in physics. But, I'm repeating myself, but, lacking that ability to predict, we just go back to the, new faces go back to the old models and keep, shoveling out that junk that says, it's a linear system and it works on equilibriums. And, I guess if you can swallow that and go on and get a job, that's a way to get a paycheck. But anybody with their right mind would look at it and say, no, it's not a linear system. It's in equilibrium some of the times, but it has these, non-equilibrium spurts, these non-linear episodes. It has increasing economic returns, which is never supposed to have an equilibrium system. And you kind of look at it and go, this is nonsense. But you have to navigate. You have to continue to map on and continue to move forward. And then that took us right into philosophy, which is, how philosophically can you help solve problems in a system that you yourself cannot predict? And that's where Bill Miller came in a large way.
Well, my professor in econ was a Newton guy. Cole, I can't resist. Cole, you got to tell him your favorite Newton quote about heavenly bodies.
Oh yeah, obviously Newton got caught in the South Seas bubble, and he says, "I can understand the movement of celestial bodies, but not the madness of crowds."
Yeah,
and so,
let's go on to Faro Problem, which we find keenly interesting. Just having on tape, you don't believe in the efficient market hypothesis, so share that with us.
Well, I would say, Bill, that I do believe in the efficient market hypothesis, that the market is frequently efficient. It's just not always efficient. Most of the time, the markets get it right within a small degree, plus or minus what would be fair value. And this is going back to John Zerwicki's work of wisdom of the crowds. And basically, if you have and Michael Movison has talked about this well, if you have a diverse group of inputs that have an incentive in order to make good decisions, and an aggregation mechanism, which would be the market, the system gets it right most of the time. It's when you have these diversity breakdowns that ultimately, you get these wide mispricings. People become overly optimistic on the way up, and mispricing occurs. Or what's happening today, you can see in the market, overly pessimistic, and there's wide divergence in certain stocks and intrinsic value now because of that fear. So, I would argue that that's the whole problem with the market sometimes, is that it's frequently efficient, just not always efficient. And your job is to figure out, well, when it's not efficient, that's when I strike, and I strike big to make those excess returns. But to the El Faro, that's a Brian Arthur quiz. There's a Irish pub in Santa Fe, and he kind of had this idea of the problem that comes from biological systems making predictions would be the similar challenge of trying to make predictions about how many people would show up at the El Faro ball on a Thursday night, I think it was, in bar. And so he kind of walked through all these different iterations of how to make the predictions, and ultimately became kind of a infinite loop, because you're always changing the prediction models, because the people are always changing their behaviors, and you can never get to the end result. You might say, well, if it's raining, a lot of people don't go on Thursday. But then once people understood that not a lot of people go on Thursday nights when it rains, then everybody shows up because the bar is empty and you can get a good seat. So he was just basically saying that that's kind of infinite loop of never being able to solve the problem, because the system continually learns and adapts. And that's exactly what happens in markets.
You wrote something that to old timers might not be a problem, but to a millennial age person might seem antithetical to what they know. I'm gonna put a little quote from your book in here. Quote, "Some might argue that the Federal Reserve, by altering interest rates and making open market purchases and sales, acts as the central controller of the economy. But as we all know, the Fed is not omnipotent. If we stop and think, we realize that the equity and debt markets have no central controller, and both are excellent examples of self-organizing, self-reinforcing systems," end quote. So, Robert, are you telling me that the Fed isn't God?
No, I thought it was the bond market was supposed to have been the God. Wasn't that at one time?
Yeah.
Bill Clinton said, I want to come back as the bond market. It plays a role. It certainly plays a role, but the system learns, and it's not always up. So, all right. So, I clearly, Jerome Powell acted in a godlike fashion when the pandemic was unfolding, and the amount of money that he was able to inject into the system using the Ben Bernanke playbook actually, saved us from a horrible global depression. So that was kind of a godlike moment. But then you learn to, the market began to learn as to what this stimulus was going to mean and things of that nature. All right, so now the Fed is really out of the omnipotent business right now. Its hands are tied. And it's not going to be godlike what they can do. The problem now is the economy is decelerating at a very rapid rate, and with inflation being sticky, it's the very first time that they're going to have to raise rates in an economy that is slowing. I think the first time since the 1970s. But the market's going to learn, right? The market will learn what's going to work and what doesn't work, and how to solve these problems. So the Federal Reserve plays a role, but I don't think it's omnipotent all the time. It strikes when it's opportunistic to strike. But this will be this is a sobering lesson for a lot of people who've been managing money for the last 20 to 30 years, that, we relied on the Greenspan put for so many years, and the Bernanke put for so many years, and the Powell struck that put, brilliantly. Now we've got to solve some problems without that put. the Fed is handcuffed, and they're not going to be as godlike in their ability to change the system. The system will then, though, change because it has to.
Robert, to follow right off the backside of that conversation about the Fed and kind of market participants thinking, what would the Fed do? You point out that Sawicki's work on collective comes up in your book. He says you need diversity and independence by the participants.
Yep.
Since we're kind of mocking the idea that people have said to us, which is, that things can't get too bad because, the Fed would come and rescue everybody. Does that mean independence and diversity could be currently lost in the stock market? And then what that would kind of lead is that it also renders wisdom, like, common wisdom is lost too.
Yeah, it's interesting. It's a very interesting question, Cole. I guess I'll take the other side of the bet. I think in some ways, when we knew that the Fed was always there as a standby, put to inject liquidity, drop rates in times of economic stress, it really did reduce diversity because everybody kind of knew what was going to happen next. And then we might argue, did the system become unstable? Yes, no. Did you end up with extremes in valuations in certain aspects of the market? Yes, no. But to the degree that everybody kind of latches on to the same solution or the same outcome, diversity does, start to break down a little bit. And that becomes a suboptimal way in which to think about problem solving. So let's push forward. If we don't have, we don't know what the roadmap is for the Fed perfectly now. We can argue that they probably aren't going to cut interest rates, or probably not going to do quantitative easing. The economy is slowing. We're in difficult positions geopolitically, supply, all the problems that perhaps in the past the Fed would have cut rates to help. They're not going to do it. Well, now you're making decisions independently and probably different than a lot of other people are making decisions because there's no previous roadmap in which to follow. Does that make any sense? Does that resonate with you?
Mm-hmm. Yeah.
In which case, that argument would suggest that the system actually becomes healthier and probably less volatile as more people are making independent decisions differently than latching on to the same solution. So in some ways, when we knew the Fed's roadmap, we knew the Fed's map, diversity was actually being reduced, not increased.
Yeah, and volatility was being reduced,
Yep.
and that was emboldening a lot of financial euphoric and stupid stuff. So let's go to Terence Odian's two studies on trading. We really love this from your book. Can you explain his work?
Yeah, very good work here. I guess I would update that if I were writing the book now. I would update that to the work of Martins and Kremers and Pettigiusto, Martin Kremers and Pettigiusto, on their work of high active share portfolios and low turnovers. So they would have updated Terence's work and basically said, yes, what you see are the superior outperforming portfolios are actually portfolios that are more concentrated, less diversified. They called them high active share portfolios. I think when I wrote the Warren Buffett portfolio in '98, we just call them concentrated. I think Warren said it was focused portfolios, that we call it focus investing. But the academicians latched onto it about a decade later and began to actually mathematically calculate the performance differentials between broadly diversified portfolios and concentrated portfolios. Concentrated portfolios having high active share because they were so different from an index. Broadly diversified portfolios having low active share because they were so similar to an index. And they ran the study and found, in fact, it's the high active shares, the concentrated portfolios that outperform the broadly diversified closet indexers. But then, and this gets to Terence's work, what they began to find out is even within high active share portfolios, there was a subgroup that did even better, and that was the low turnover portfolios. And this is Terence's work about trading is hazardous to your health. Those that were more kind of buy and hold, had lower turnover ratios, were far superior to even high active share portfolios that had high turnover ratios. And so then
Robert,
Yep.
Now you're speaking our love language here. We just had Ankur Parikh at our first investor conference, and he's done some additional great work on Martin Kremer's on ActiveShare. So what we like to in our work, we think there's 4 ways to deviate, and you've covered a few of them. It would be stock picking, what we call the John Templeton factor, which is courage, right? Being willing to buy when everyone else is crapping their drawers, and then concentration, and then long duration. And I, as the years go by, I almost think the hardest thing for people in the value world to do is to do long duration.
Oh, it is, because from a behavior, you're spot on, Bill. You're spot on, which is, and this is what I've wrestled with, and we wrote a little bit about it in the Money Mind book. Is that if you're going to be concentrated, low turnover, and go for long duration, which is the most mispriced part of the market, right? That you have to come up with some alternative way in which to measure your progress. I think just relying on short-term prices is going to be just too psychologically challenging for most people, because of the prospect theory insights that Tversky and Kahneman gave us, that when people rely on price and price goes down, it's less discomforting than an equal unit going up. So you've got to come up with some alternative. And you may like this, but I said, it's just unfair that we have to compete against private equity. Private equity, for the most part, is a concentrated, low turnover, long duration bet. But they don't have to price their portfolio. Their NAV is $1.
It's not in the newspaper.
Yeah, it's not traded every day. And it's interesting when you look at private equity results. The NAV is like $1, and it goes to $1.02, and then it goes to 99 cents, and then it's $1.04. It doesn't bounce around a lot. And then when they sell it, it's worth $1.30. It's like, where did that come from? But they don't have to wrestle with that ever-changing stock price that we have in the public markets. And so I haven't bridged. I'm looking for ways in which we can help the client understand their economic progress as if it was a private equity fund with no pricing. So we try to help them understand, sales, earnings, cash flows, return on capital, and that progress of those attributes as if they were a private equity owner. Does that make sense?
It does. And so I'm gonna tear up I'm gonna pull a Tom Keene, tear up the script, and let's go right back at this. So isn't that, Robert, why Buffett used book value to track his progress? Because what I think we've talked a lot about this here the last few weeks, but return on equity is nothing more than book value growth. Okay. And what everyone does is talks about return on equity, and to your point, they don't connect that up to what it means in economic progress, right? What does that mean per share that's still sitting out among the existing holders? And even Buffett, what was it, 2 years ago? He said, we're going to quit publishing book value per growth, or you shouldn't pay attention to it like we have in the past. So how do you do that in a world where we don't think there's really a benchmark for tracking economic progress in companies?
Yeah, there was a lot of reasons why, Warren moved off the book value, because, so much of the value and so many of the investments wasn't being captured. The change in value was not being captured by the change
on a GAAP basis.
On a GAAP.
Yeah, on a GAAP basis. Yeah.
And a lot of people are starting to write about the value of intangibles, which aren't captured in a hard book basis, but we need to be thinking about how do intangibles add value, and how do they change over time. I thought, Cole, that when Warren introduced, and it was early 2000s, my mind's thing is that he started to look through earnings. Remember, he was doing look through earnings in the Berkshire Annual Reports, where he said, I own X% of the Coca-Cola company, and so therefore I own X% of its EPS. And he tabulated all of his percentage ownership of earnings of Cap Cities ABC, American Express, Coca-Cola. And he, for several years, was showing you the growth of his look-through earnings. And he basically did this long episode in the Berkshire Annual Report narrative about what you focus on is look-through earnings. And if you focus on look-through earnings, not stock price, you'll make better decisions. And I thought it was brilliant. I said, yeah, I'm all over this. And we did that, for our clients. It became a little problematic, because as you grew as a firm, you had new assets and things like that. It mathematically was always, somewhat problematic to solve perfectly. But the concept was brilliant, which is he was giving you an economic way to think about the growth of your portfolio independent of price. And then he stopped doing it. And nobody could ever figure out. And he flirted with it a couple of times, came back once or twice, but basically over time quit putting it in the Berkshire Annual Report. And I actually, saw Carol Lewis several years ago, and I said, "Look, Carol," I said, "I know he's not going to answer this, but if I ever, my question submitted to you would be, will you ever reinstate look-through earnings?" And she never asked the question. So I'm like, why? What happened? Why? Why do we? But that conceptually, you see where I'm going, and I think if judging our progress by price has all its pitfalls, as we know it does, behavioral pitfalls, then we just have to come up with an alternative way. And if you ever go to a private equity, review, or a private equity annual performance review, it's all economics. They're just talking about the economic returns of their business. And I'm looking at them going, that's exactly what we should be doing in publicly traded portfolios. And in some ways, systemize it in such a way.
So funny that you mentioned that, because we recently read The King of Capital, and basically I concluded that Schwartzman was doing on a private basis what we try to do with public equities. Mm-hmm. So Robert, we're kind of making the argument theoretically to people that the next 10 to 15 years are going to be more like 1964 to 1981 than they are going to be like the last 10 or 12 years, or 81 to 98. Mm-hmm. So you get into a subject, what you call the Sidewinder market, and you use the late 70s as your picture. Explain to the listeners what a Sidewinder market is. People under 40 probably don't know what that is, and talk about how much different it is to navigate as a investment stock picker.
Well, I think we call it a sideways market, and maybe I did call it a Sidewinder. A sideways market basically is a market that over a period of time actually doesn't go up a whole lot. Compared to 1980, I guess what the beginning, Bill will correct me, 1982, the great bull market began with the interest rates topping out at 15%, and summarily went down, and we had this incredible market of, average annual return, I think it was 18% per year for, almost 20 years. And for a large part of most people's existence, they've had the tailwind of multiple expansion and things of that nature, and markets have gone up even in the last 2 or 3 years. We've had some exceptional markets, but there are parts in history, and to your point, Bill, we may be heading back into those periods where returns in the market are not going to be double digit. I think it was McKinsey and Company that started to float the idea of lower for longer. You have lower GDP growth, you have lower yields in the bond market. So your aggregate returns of balanced portfolios are going to be nowhere near, what they had been in the 80s and 90s for sure. And so you end up with much lower returns. So if you're an index investor, that's going to be challenging. It's going to be hard for you to reach some of your retirement goals or your income goals that you have later in life. So what do you do? And then the answer is that you've got to become the stock picker. You've got to find out, what stocks have the highest future expected returns up and beyond what the aggregate is going to do, and then being able to bet them accordingly. And so it's a challenge because, as Warren says, if you're a know-nothing investor, buy the index fund, which is exactly the best advice. If you really don't know how to invest, you don't know how to think about stocks in the market in an optimal way, just be an index investor and turn off the TV. But now index investing going forward could be very suboptimal returns, or returns that won't help you reach your goal. And so if that's the case, and always be careful, Bill, when a stock picker tells you it's going to be a stock picker's market, but it may be that we're heading towards more of a stock picker's market, which is what works in sideways markets.
Robert, if you were Buffett's widow, would you rather have Berkshire Hathaway, or would you rather have the index he's going to put her in?
God, great question. Because I do think that Berkshire will do okay, but it's going to be kind of high single digit, low double digit type number. And that, I think, Warren has basically said over time, we could probably skin the market by a point or two, but nothing like, 10 points like he's done over history. I'd probably take Berkshire just because it probably has much less downside risk than the S&P 500 does.
Well, yeah, and in that part of your book, you were talking about systems versus individuals and kind of the mathematics of it. And we love that because it's the difference of a system, aka the stock market, doing poorly versus a stock maybe succeeding. So let's see. I'm gonna read a quote from Kenneth Arrow in your book. Our knowledge of the way things work in our society or in our nature comes trailing clouds of vagueness. Vast ills have followed a belief in certainty. End quote. Are there things you feel personally today that people treat with certainty that are far from certain?
Oh, sure. It never ceases to amaze me, how people are so certain as what's going to happen in the market over the next couple of months. And I kind of look at this and, we all watch the talking heads on Bloomberg or CNBC or whatever your favorite program is. And I just wonder, knowing that, the odds of them actually being able to actually predict what's going to happen in the next 3 to 6 months is so low. Why do they get so much airtime? And then it finally occurred to me that most of the people that actually are watching television are really attracted to people that can actually tell them what's going to happen, whether they're right or wrong. It's kind of like, I want to listen to someone who's going to tell me what's going to happen next month. Never mind, he has no qualifications doing so. I just enjoy listening to somebody who can tell me what's going to happen the next 6 months. So, it never ceases to amaze me that we spend so much intellectual capital trying to figure these things out when I just got finished explaining why this can never be figured out. But, that's so be it. That's what it is. I would, I'll throw out, I'd love to pivot to philosophy, because I think what I learned from Bill was it's okay that you can't figure out what's going to happen in the market the next 3, 6, 9 months. You may not be able to figure out what's going to happen over the next year or two, although the odds would tell you, since history, your odds go up to the degree that your holding period is extended. But what he taught me was, philosophically speaking, there is a way which you can profit without knowing ahead of time what's going to work. And the answer was his studies of pragmatism in William James, which is just wait until the optimal solutions begin to show themselves. And it could be a company, it could be a strategy and stuff like that. It eventually will show itself. And the pragmatist then, understanding the cash value of this new idea, this new company, this new strategy, whatever the case may be, the pragmatist would just latch onto it and run with it. Although, a lot of people are kind of operate from the correspondence theory of truth, which is, I already know what's going on. I've already figured it out. I already run my company like this. I don't need any new ideas.
Sure.
Bill Miller would be a guy that has lived his entire life evolving and latching on to new ideas, and had a great track record over time without ever having to worry about predicting what's going to happen over the next couple of years. I've just float that up. Does that resonate with you guys?
No, that makes sense, because I remember when, we talked about before we started the show, Bill and I chatted with Bill back in the spring of 20, and we asked him what he thought of oil. And I remember Bill saying that he was a bear on oil.
Yeah.
And so, to your point, he's a very incredibly brilliant and intelligent investor. And at the same time, you can't know everything about everything, and that's not the goal.
Yeah, he understands mispricing. I mean, I think where Bill excels is his ability to understand. Like today, he loves home builders, and he actually loves energy too. And he's probably, if oil stays at this price and goes higher, he's going to be right. But he understands the moment. He understands what's going on in the moment, and therefore, where is the mispricing in this moment?
Sure.
That doesn't mean, but that doesn't mean, the moment will be, that same moment a year from now or 2 years from now. He just understands the current moment and understands what's mispriced in the current moment. But at the same time, what the challenge of understanding Bill is that he's doing 2 or 3 things at the same time in his portfolio. He's buying oils and things like that, but then he's buying some really cool businesses. And then he's buying, cryptos and Coinbase and all that. He's got so many different strategies running in the portfolio at the same time. But a lot of that future stuff that he's latched onto, he latched onto it because it was working. A pragmatist would latch on to the cash value of an idea. If it is working, there must be something good to it. And then you try to figure it out. That was AOL in the very beginning. It's working. What's going on here? He figured it out. And, he's done that with so many things in his career that if you're a pragmatist, if your philosophy is pragmatism, you don't have to really get weirded out that I am not going to understand. I can't predict what's going to happen next year, 2 years from now, 3 years from now. But if I'm a good observer, I can begin to understand what's working 2 years from now, 3 years from now, and then you latch onto it and go with it.
Robert, what books are you reading right now personally?
Oh, good question. I'm looking up on my library shelf. I just got finished, one of my favorite books, and I just read it again, was The Metaphysical Club by Louis Manan. I think that's a phenomenally great book, and that speaks to pragmatism. I read Harold Bloom's How to Read and Why. I think Harold Bloom recently passed away, Yale professor of literature, and God, just what a brilliant guy. And his first line in the book, I think, was, where shall we find wisdom? And the answer is in literature. And so, I always try to keep I was underserved in the great works of literature and tried to catch up with that. What else is over there? Pinker's book on rationality was good. What else is up there? I like William Green's Richer, Wiser, and Happier. I know that was a really popular book for a lot of people.
Yeah, I just got done reading that about 2 months ago.
You won't go wrong with that. I read, let's see, I'm going over here. A lot of Richard Rorty. Rorty was if you think about the first four great pragmatists, it was Charles Sanders Peirce and William James, Oliver Wendell Holmes, and John Dewey. Richard, and Bill turned me on to him again. Richard Rorty, phenomenal philosopher, and going through his books. And then for fun, I always read Sherlock Holmes. I just never get tired of reading Sherlock Holmes. He's a great detective. He solves puzzles. I like his attitudes about how he does it, and so I try to keep diversified. I read, Sherman Kent's book on strategic analysis, or it was called Strategic Intelligence. It was a definitive book written in the 1940s, going through that, trying to figure out, okay, what's going on in Russia and how to think about that. So I try to read a lot of different books at the same time on different topics.
We're kind of getting late in our time, so what I wanted to come back to was, is there anything that we haven't talked about from your writing, Robert, that you think needs to be mentioned?
Great question. I think you've done a thoroughly great job in asking the questions, well prepared. God, you covered so many wonderful topics. I'm thumbing through the book. You covered a hell of a lot of good stuff here. Congratulations.
Only Cole would ask for more.
Yeah.
Yeah.
I'm a glutton.
He's like his mom.
Yeah. I think, the one, so there's a part in the book, and I think it was John Holland, talked about exploration and exploitation, right? So you exploit what you know, what is working and what is currently working, you exploit it, and you continue to make a lot of money. But how much time do you spend on new ideas? And so, in the book, I think we talked about, it was a Norwegian fisherman, they would have 12 boats going out, and 10 of them would go to the proving grounds of where the fish had been found, and 2 of them would just take off on a random direction. The medicine man in the Indian camps looking for the next hunting ground would roll the bones, and invariably he would send a lot of his hunters out in the direction where they had found the last bisons and things like that. But he'd send 2 or 3 in these random directions, and it's the randomness of going into different ways and different parts. It's just like leave yourself wide open. Give anything a chance. Biographies, literature, just give anything a chance to see what it does to your mental acumen. And so there's no plan to it. It's a randomness to it, but it's actually an art of exploring new ideas. Is a randomness act of being able to continue the diversity of how you get ideas. And I underserved that for so many years because I just got specialized on Buffett and specialized on finance and accounting. And, I still read a lot of that stuff, but boy, here in the later years, I'm trying to go in so many different directions and grasp on to so many different ideas from so many different sources, fiction and nonfiction. That's a big part, I think, of building worldly wisdom.
I agree with you, and I think we all fall a victim in this business, being too insular, to what we do versus looking at the world around us. So I've already written down The Metaphysical Club as a book I need to check out. And this is going to wrap us up for our episode. A big thank you from both Bill and I, Robert, for joining us today for the podcast. Robert's book, Investing, The Last Liberal Art, explains how we need to think about not only the progression of human learning, but also our own personal learning. I know how many of the listeners probably already own this book, but if you haven't, you're missing out. Go buy his book today. It's hard to see who can't benefit from this. I mean, I think educators, business people, investors, like we've talked about in a lot of our discussion today. I also want to thank my dad, Bill, for hosting with me today. It's been quite a bit of fun. For our listeners, if you have a great book that you'd like to recommend, email podcast@smeedcap.com. That's podcast@smeedcap.com. Thank you for joining us for a Book with Legs podcast. We look forward to the next episode.
Thank you for listening to A Book with Legs, a podcast brought to you by Smeed Capital Management. The material provided in this podcast is for informational use only and should not be construed as investment advice. You can learn more about Smeed Capital Management and its products at smeedcap.com or by calling your financial advisor.